S&P 500 Index, SPX, Long-Term Chart Analysis, a Bullish Perspective. The S&P 500 Index, SPX, is currently experiencing a slight sideways movement, with a minor weekly decline of -0.06%. Nevertheless, our outlook remains bullish. The 200-day moving average has proven to be a robust support level, effectively curbing the selling pressure witnessed in early August. Our conservative S&P 500 strategy is meticulously crafted to protect investors during bear markets. It promotes resilience through short-term downturns without triggering sell alerts. This strategy is grounded in long-term chart analysis and remains unaffected by emotions, news events, or other short-term market fluctuations. It is a forward-looking approach that anticipates market dynamics without attempting to predict every minor market shift. We are currently positioned bullishly with investments in the Rydex S&P 500 Nova Fund, RYNVX, and other S&P 500 index funds or ETFs like SPY. This strategy underscores our confidence in the S&P 500's long-term growth potential. Current S&P 500 Index, SPX, analysis. Last week, it was noted that despite the Federal Reserve's easing measures, mortgage rates did not decrease as anticipated. Instead, the 30-year mortgage rate rose. This week, while avoiding political discussions, it is essential to recognize that the prospective policies of a future president can significantly influence stock market trends. Polling averages indicate an increase in Donald Trump's chances of securing another term in office. Concurrently, concerns are mounting over his proposed universal tariffs of up to 20% on most U.S. imports. These tariffs could notably impact the S&P 500 SPX. Analysts at Barclays suggest that a Trump administration could impose 10% tariffs on all imports, with a 60% tariff on Chinese goods, potentially reducing SPX earnings per share by 3.2% in 2025. An additional 1.5% decline could occur if U.S. trading partners retaliate with tariffs. While immediate implementation of such tariffs is unlikely, Trump may be positioning himself for negotiations, particularly regarding China's plans to manufacture inexpensive cars in Mexico for the U.S. market. Tariffs might be necessary to safeguard the U.S. auto industry, a development under close observation. Market trends and volatility. Despite a bullish market trend, it is crucial to acknowledge an overbought market condition. We anticipate continued gains through October. However, the market's response to post-election developments remains uncertain and may lead to increased volatility. Historically, holding cash during volatile periods, such as U.S. presidential elections, has not yielded favorable results for investors. With the upcoming elections, investors should brace for additional volatility and potential policy shifts, yet the stock market is expected to maintain its upward trajectory. Key economic reports released this week. Several significant economic reports were released this week. U.S. consumer inflation expectations for the next year remain steady at 3% in September 2024. Expectations for food prices rose slightly to 4.5%, while college costs remained unchanged at 5.9%. The New York Empire State Manufacturing Index dropped to -11.9 in October 2024 from 11.5 in September, surprising analysts who anticipated a figure of 3.8, marking the worst reading since May and indicating a renewed contraction in New York State's manufacturing sector. The European Central Bank, ECB, reduced borrowing costs by 25 basis points, aligning with market expectations. This follows similar actions in prior months, lowering the key deposit rate to 3.25%. Inflation in the Eurozone dropped below the ECB's target of 2% for the first time in over 3 years. U.S. retail sales rose by 0.4% month-over-month in September 2024, surpassing the previous month's 0.1% gain and exceeding market expectations of a 0.3% increase. Miscellaneous store retailers led the growth with a 4% rise, followed by clothing, 1.5%, health and personal care, 1.1%, and food and beverages stores, 1%. U.S. unemployment claims decreased by 19,000 for the week ending October 12, marking the largest drop in 3 months after reaching a 14-month high the previous week. The total claims fell to 241,000, well below market expectations of 260,000. This decline followed a surge due to disruptions from Hurricanes Helene and Milton. U.S. industrial production fell by 0.3% in September 2024, exceeding market expectations of a 0.2% decrease. A strike at a major civilian aircraft producer and hurricane impacts contributed to this decline. U.S. housing starts declined by 0.5% to 1.354 million in September 2024, in line with market expectations, following a downwardly revised 7.8% rise in August. Building permits fell by 2.9% to 1.428 million, missing forecasts of 1.46 million after a 4.6% rise the previous month. Conclusion: the SPX position within this strategy remains bullish. Aggressive traders should consider investing in the Rydex S&P 500 fund RYNVX or other bullish S&P 500 index funds or ETFs such as SPY. Despite potential volatility related to the upcoming U.S. presidential election, the long-term outlook for the S&P 500 remains positive.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.